It's fascinating to me when you look just 6 months ago what the Fed was saying, where interest rate projections were, housing market predictions, and even all the things that are changing in real estate with the NAR changes as far as real estate compensation. So we're going to look at some really interesting data, things I would want to know if I was a home buyer, home seller, especially if I worked in the industry, which I do as a mortgage professional or a real estate professional. But one of the things I think that it's safe to say is things will always change. That's right, things are always changing, but sometimes things change faster than normal. And I would say we are getting ready to go through a cycle where things are going to change rather quickly. And so let's start with the thing that is obviously driving a lot of this change in the market, and that is interest rates. So this is the 30-year fixed rate as of today, 6.43%. Remember, everyone's rate is different based on credit score, down payment. But I like to look at the scale of the same place every time to kind of get the trend or direction of rates. And again, I always like to show this is amazing. I mean, in end of 2023, we were 8%. And it was just back in May of 2024, this year, we were still at 7.5%. Now we fast forward to the end of August almost, and now we are finally dipping below 6.5%. What's the big change? Is that the Fed met in Jackson Hole, Jerome Powell talking about lowering the Fed funds rate, being, the Fed usually comes across what they call hawkish or dovish, meaning what direction they're heading. And he is definitely signaling to the market that we are on a new cycle now, and we expect rates to fall. He is definitely setting up to cut the Fed funds rate going forward. It's really just a question of how much. When we look at the Fed watch tool that I use to kind of look at the market here, and of course it's just a tracking of the probabilities. No one knows for sure what the Fed's going to do except the Fed. But right now there's a 100% chance the market's pricing in a rate cut. It's just between 1/4 or 0.5%. If we go to the end of December, the last rate cut of the year, we are predicting 75 to 100 basis points worth of cuts. And then I like to look all the way into the end of next year. And look at this, the entire market, for other than a few small percentage, predicting us to be in the 3.5% range or lower for the Fed funds rate. That is huge, because that is a long way down from where we're at now, especially just over the next year, call it year and a half, meaning that we are definitely on a cycle of lower rates. No one really expecting any different. It's just a question of how low will we go. Now remember this, when it comes to rates, the market will price in rate cuts before they happen. So as the Fed speaks and starts indicating where we're likely to end up, the market will price that in, and so we will get lower rates usually before the Fed starts cutting. Now with that being said, sometimes we have the opposite reaction where we've had the Fed lower rates, but then we get a little bit of higher interest rate because the market was pricing in a higher cut. Like right now, the market is predicting 1/4. So if we get 1/2, we probably will get another little dip in rates. But if we only get 1/4, that's kind of what the market has already priced in. Now, one of the things that you might have heard, basically there's a difference that lenders keep between the 10-year treasury and the 30-year fixed rate mortgage. Right now it's been averaging 2.5%, 2.58%. If that spread were to narrow to 2%, which is usually about where it's at, the 30-year fixed rate right now would be 5.91%. That's important because what they're saying is, even if we didn't change anything now, if the bond market stabilizes, volatility stabilizes, and the Fed is on their way with these rate cuts, there's another 0.5% in interest rate cuts just in that right there. So when people say that rates could be a lot lower than what people think, I am in that camp. I've been saying for a long time that rates would be lower, and I was wrong about the timing, but I did say when they started cutting, rates would get lower faster than what people think. Now, is that a good thing or bad thing? It's definitely going to increase demand because people buy on payment, right? If we look just from last year, let's say we even look from 6 months ago where rates were 7.5%, payments depending on the price point can be a couple $100 or more less per month. that is going to drive more buyers in the market. And to kind of make that point, when we look at mortgage application demand, or mortgage application jumps in mortgage applications, you can see right here we've had this drop in rate, and mortgage applications just jumped up, meaning that, again, market just pricing in lower rates. And the Fed in Jackson Hole, here's what they said: the cooling in the labor market condition is unmistakable. We do not welcome any other more cooling in the labor market conditions. We will do everything we can to support a stronger labor market. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon, and the time has come for policy to adjust. The direction of travel is clear, and the timing and the pace of rate cuts will depend on the incoming data. So again, nobody predicting rates going up. No one has a crystal ball. Just a question of how fast. And in that Jackson Hole meeting, he said the word labor market 27 times. And why is that? Is because, remember, the Fed has a dual mandate to keep rates low, but also to stabilize unemployment. If employment was stronger, that gives the Fed more room to keep rates higher. With the revision in a lot of these numbers from the Bureau of Labor Statistics, meaning that unemployment is worse than what it was looking like, especially with the talk of a recession, that is, again, just more pressure for rates to come down. Now, what would I do with this? If I was a buyer or seller, my advice is always going to be the same. Don't try to time the real estate market. It never works. But if you were going to time the market, this is pretty darn good, because we haven't got massive increase in demand, which is going to happen. If we start selling Ferraris, Ferrari payments are $2,000 a month, and we can sell them for $500 a month, people will buy. And even if you go buy a car, I just helped my son buy a car, it's crazy. They have like 6 and 7 year financing, which I think is a terrible move for a car, but you can see the car industry understands you lower the payment, you will get people to buy a more expensive car. Well, all of a sudden, as far as affordability goes, if rates fall, it's going to push more people in the market. Then one last thing here, when we look at Zillow's updated numbers on the market, they are predicting housing prices are up 2.8% from July of last year to now, but they have adjusted this downward, that they're really only basically predicting about a 1% or 0.9% over the next 12 months. And that's just because they realize that affordability is still not that great. We need rates to come down far enough to increase affordability. And nationally, there's still just not enough supply to keep up with the current demand. Now, the supply is growing, but houses that are priced right are still selling, which if you've sold a house or bought a house, you know that to be true. Remember, every real estate market's different. I mean, I'm here in Oviedo. You can see the top 10 most competitive cities in Florida: Alafaya, which is right around me, Oviedo, Winter Springs, and you can see the top 10 list here. So you got to know your local market and work with a real estate agent. That being said, if you are a real estate agent, we just switched over to the buyer's broker's agreement. I have heard people doing and trying all kinds of different things. If you're a buyer, you are going to sign a buyer's broker's agreement to work with a real estate agent, which will give you the ability to have different conversations with agents about not only how they can help you, how they're going to be compensated. I think it will overall be a net positive. There just wasn't a lot of guidance on this, so a lot of that's playing out in the market. If you're a real estate agent, it's going to always be the same conversation. Quite a few agents I talked to have said, you know what, it's not really that big of a deal, and they're actually getting more buyers, and the better agents are going to do better, because as things require more skill, especially with buyer broker agreements and different things, the better agents are going to rise to the top. You want to make sure you're one of those top agents. And then overall, what I would say is this: we are on a new cycle. We've had a lot of changes. We had a lot of changes with rates going up, and now we're on the way down. Mortgage demand is likely to go up quite a bit, in my opinion, over the next year. Is the market going to go crazy? No, because affordability is still not great, but it is going to be improving. That's going to drive more buyers into the market. And we're going to pay a lot of attention to that 10-year and 30-year spread. We're going to look at the Fed meetings coming up and more what Jerome Powell says during those meetings. And the star of the show from now to the end of this year will be rates, because that will really dictate kind of what's going on in the market. And just as a side note, for the Hometown Heroes program, which is exclusive here to Florida, that is currently out of funding. So at this point, that program, if you got into it, great. If not, who knows if they'll do it again. But so that's what the data shows. If you're a real estate agent, work hard, build a daily success plan. I like to look at the big frame. Every buyer signing a buyer broker's agreement, you're going to figure out the best way to do that. You create the least amount of friction, and you figure out the best way to explain that to a buyer. Those are the realtors that are going to win. And if you're a buyer or seller, don't time the market. If you need to sell your house, sell it. If you need to buy a house, get pre-approved. Buy now before everyone else starts jumping in, because as rates drop, that will drive more competition. And in the more competitive markets, like here in Oviedo or Central Florida, that's going to make it harder to buy a house. Anyways, that's what the data says for this week. If you have any questions, reach out to me. As more information becomes available that moves the market, as always, I'll cover it right here. Have a great day, a great week. Talk to you soon.